Hello everyone and welcome to our Enterprise Management Incentive or EMI Options webinar. My name is Matt Wilmot. I'm a partner in the corporate finance team here at PKF Francis Clark. I'll be hosting today's webinar alongside my colleagues Kate and Thomas, who are tax specialists from our share incentive team. During the course of this webinar, we'll be exploring how EMI options work, when they're most effective, and what makes them a truly compelling part of the management incentive toolkit. We'll also be looking at some of the practical issues such as valuation, vesting and eligibility, and how these schemes can be structured in a way that truly drives personal performance, but as also wider strategic business objectives. At its core, EMI is about incentivizing management so they have a real stake in the outcome of their achievements. And it can be really effective, particularly in high growth businesses. It can contribute to management retention and ultimately add shareholder value. So let's begin with some introductions. Kate, would you like to go first?
Hi, I'm Kate Culley and I lead the shares and incentives team at PKF Francis Clark. We're a group of 6 experts putting in things like EMI share option plans, but we also do things like growth shares and other incentive arrangements.
Thanks, Kate. Thomas.
Hi, my name's Thomas Oldham and I work in the share incentive teams under Kate, doing the same kind of thing.
Right, so we've got our specialist. We've planned out the webinar to cover as broad a number of topics as we can, but please feel free to ask any questions as we go. We'll try to pick those up at the relevant time or at the end if we don't get to them along the way. So let's start with the basics. To Thomas, why don't you give us an overview? What is an EMI option scheme? What are the fundamentals?
Yeah, thanks, Matt. So what we mean when we talk about EMI, it's a form of tax-advantaged option scheme. So what's an option, I guess, is the next logical question. As the name suggests, it's the right or opportunity to acquire shares in the future through the use of options. Employees are awarded options and they don't need to pay for anything when they get them. And then they can, at a later date, exercise those options to acquire the shares by paying a previously agreed upon exercise price. So for EMI specifically, there are various tax savings, which we'll cover in more detail. But it's very attractive for businesses who are looking to align employees with the wider business vision. For startup or early stage companies in particular, it can be a very attractive route as the cost to the business of putting in an EMI scheme is very low beyond the actual implementation of the scheme, compared with more traditional means of incentivizing employees, such as something like a cash bonus. And it can also help to attract very highly skilled employees who may have a background of working in high growth companies, who know what EMI is and see it as something very useful because it can be so lucrative on a future exit. There are a few jargon points that we often talk about with EMI, and I thought it would be helpful to provide a brief definition of those here. So when we talk about exercise, what we mean by that is the point at which people get shares after paying the exercise price. So when you get an option, at that point you don't have anything except the right to acquire shares in the future, and that is, the future. What we mean is either typically after a certain length of time has passed, or often on an exit. And since it's it's an option, there's no requirement that people ever exercise these. It's if people want to exercise. And the other one which we often get asked questions about is vesting and what that means. So what we mean when we say an option vests is options that build up over time. So you might be awarded an option over, say, 100 shares, and then they vest over the next 4 years. So you can exercise 25 after year 1, 50 after the following year, and so on. And that just something to define, because we often get confusion about that from people who are more used to, say, American style share incentives, where vesting is much more common.
Thanks, Thomas. So we've mentioned sort of tax advantage. So that's obviously at the core of this. Kate, perhaps you could elaborate on some of the advantages and the sort of the tax benefits that they provide.
Of course. So in essence, there's no real difference between an EMI and a non-EMI option. There's the EMI wrapper, assuming you get all the bits and pieces right to make it an EMI option, which is just very complying with various rules. Means though that you have a more attractive tax regime. So and the tax regime we're talking about can be very helpful then in attracting employees to maybe a smaller business. In essence, regular options are taxed as income when they're exercised. So you get to the end, you exercise your options, and then you're paying probably PAYE on the gain that you're making on exercise, and then you need to figure out how to fund the tax you need to pay. For most EMI options, you actually don't have any tax on exercise, but assuming that we're actually selling the company at the same time, at that point, you'll also have a gain, which will be a capital gain, and you'll need to fund your capital gain out of your proceeds. As you're probably aware, capital gains tax rates are significantly lower than PAYE or income tax rates, and so there's usually a significant benefit in having an EMI option. Also, if you've held the option and or the shares for 2 years, you also get into the lower tax rates of what I still call the entrepreneur's relief rate, but everyone else now calls business asset disposal relief. That's the one that used to be taxed at 10%, but the rates are now creeping up. And I think it's from 26 onwards, we'll be at 18% on that, but still it's obviously significantly more attractive than paying 40 or 45% income tax and then potentially national insurance as well. Other thing to mention is that there will be potentially a corporate tax deduction as well, but I think we'll talk about that later. And I guess if you want me to give you the essence of the EMI tax benefits, EMI mimics holding a share from day one. So you're in capital usually from the beginning, and that is the most attractive tax feature for employees of the arrangement.
Thanks, Kate. So I think when we send around the recording after this, there'll also be a sort of one-page slide which summarise some of these tax benefits as well, just so you can all visualise it rather than just being described to you. So hopefully that will be useful. Okay, so if a shareholder base wants to think about implementing an EMI scheme, how do they test that? How do they check they're eligible? How can they sort of make sure that they can implement it?
Yeah, there are a few main qualifying areas for companies to be aware of, and you can sort of group them into categories of company requirements, requirements for the employees, requirements for the shares over which the options are to be granted, and then specific requirements for the EMI plan itself. So just taking each of those in turn. For the company, they must be of a certain size, so they can't have more than 30 million in gross assets, and they must have less than 250 full-time employees. There are also certain kind of trades that are restricted from using the EMI scheme because HMRC sees this as a method of incentivizing high growth companies. Certain trades such as property development, energy generation, farming, and accountancy, sadly, are excluded from making use of this scheme. And then there are also some points about structure. So if you're in a group of companies, EMI options have to be granted in the parent company. And HMRC do provide quite a useful facility to allow you to test this, whereby you can apply for advance assurance to say, look, here's our business, here's what we're planning to do. Do you think that we'd be able to qualify for advance assurance? And that's something that we'd always recommend companies to go and get in advance of putting in a scheme. So turning towards people, the people that are eligible for EMI have to be employees of the company. And they must work either 25 hours a week for the company, or if they're not full-time, or they work less than that, at least 75% of their working time has to be for that company. The shares over which options are granted, there are various points, but the important point is that they're ordinary shares. They don't need to be voting shares, and we'll discuss that a bit more later. And then the plan itself, there are some quite complex rules about what kind of things you need to include that we discuss in detail with our clients. And because of these complexities, we'd always recommend that people get professional and legal advice before putting these in, to ensure that none of the requirements are inadvertently breached.
Thanks, Thomas. We've had a question on that segment there. So it's around the definition of an employee. So what the question is an employee defined as a PAYE payroll employee?
That's probably a fair description. The most common group of people that we have, you may not comply, would be a contractor. Quite a lot of people, work closely with contractors, and you can grant them options, but they won't be qualifying EMI options, and the tax rules are slightly different for contractors. So it's the point that I think Thomas was mentioning, is that you may be an employee, you may be a part-time employee, you may be a director who's employed by the company, and all those groups of people can qualify as long as they work the minimum of 25 hours a week, or if less, 75% of their working time. For instance, if you've got someone who's part-time, maybe dealing with childcare at home, they might meet the 75% requirement.
Thanks, Kate. So whilst not the subject of this webinar, if a company isn't eligible for implementing an EMI, what
Mhm.
else might they do?
Yeah, where else do you look in the
Where'd you go?
toolbox for a
Where'd you go?
solution? Yeah, so yes. So examples that we quite commonly come across locally, maybe you've got a hotel, or maybe actually you've exceeded the gross assets test, or sometimes we deal with companies in subsidiaries, maybe owned by a larger company further up the chain, or a private equity group. And that group are unlikely to qualify for EMI. So what might we do instead? Well, one thing we might do, for example, for the hotel company, is we might do something called a CSOP, which is a company share option plan. That is one where we don't have the trade test or the gross assets test. There's no size restrictions. So a CSOP is quite similar to an EMI, slightly different rules, and also slightly different limits. And we talk about the limits in a minute for how much volume of options you can grant. But that's probably quite an attractive solution. And then we move on from the HMRC sort of tax advantage schemes potentially to other solutions, which might suit maybe our notional private equity subsidiary, and that might be something like gross shares or something like that.
Thanks, Kate. So if a company is eligible, what other things might they want to consider as to whether an EMI is the right for that company?
Yeah, so it all depends. All companies vary. So some good examples that I think Thomas already sort of indicated. Startups, high growth companies, good fit for EMI. Because what you've got that potential for growth, and also you're de-risking people on the way in, because options are not shared, so you're not committed at that point. You have that fabulous opportunity in the future. EMI can also be quite a nice solution if you've got employees coming up through who you effectively groom probably to take over the business. Potentially you're going to look to do an MBO later on. So you'll bring them in potentially as, say, 5% shareholders or something now, with a look to then grow their shareholding in the future by various mechanisms. So that can be a nice solution. We often also talk to family companies who might be looking to do EMI. That can be more tricky. It's not impossible, but you need to think how they're going to realise value. It may be that they realise value via a dividend stream on their shares. That might be effective. If you're looking for them to sell the shares in the future and you're not planning to do an exit, you might need to think then about how you're effectively going to recover those shares from them and how you're going to buy them out. So some slightly different things to think about for that group. So the most important thing, of course, though, I would say, is that you need to make sure that the staff are actually incentivized by what you're offering. And when I talk to clients, I always say, let's think about the end game. What's the future look like? What sort of variations do we have? But at least we've got then a sort of shape of what we're doing and how that's going to fit into your future plans.
Yeah, so I mean, it sounds like alignment with the broader strategic goals is absolutely fundamental in designing the scheme. So thank you, Kate. You mentioned limitations before. So in terms of the value of the shares that are being received by the employee, what are the limitations there?
Yeah, so there are limits both for the individual in how many in the value of the options they can be granted, as well as for the company as a whole, how many EMI options can you grant in total. So for an individual, there's a maximum limit of 250 grand. And for a company as a whole, they can only grant options over £3 million worth of shares. For some companies, that might immediately seem like quite a small limit, but it's important to bear in mind that for EMI, we're considering the value of the shares under option, which is not going to be the same necessarily as the value of the company as a whole. So tax valuations to calculate the value of those shares specifically are often able to apply a large minority discount. And what we mean by that is to take into account the fact that the shares that they're getting, say you grant options over 5%, that's worth quite a lot less than, say, a shareholding of 75% or 100% if the owner currently holds the business. And so that minority discount allows us to squeeze quite a lot more shares into the limit. If that limit isn't enough, they can always use alternative structures. Kate touched on hurdle shares or growth shares, I think, which are a type of share class that participates only above a certain company value, and which usually leads to a lower initial value.
You could grant EMI over growth shares, can't you? So that might be your solution.
Yeah, although it is more complex. But yes, if we were to consider, for an example, say a company that has a valuation of the whole of the company is worth 10 million, and you'd like to grant options over 5% of the shares on a pro rata basis, that would be 500k already, which is outside of your individual limit. But if you were able to get a minority discount of 75%, then those shares would only be worth 125k. The level of minority discount that's appropriate is heavily dependent on the company's individual circumstances. So the 75% example that we've just given may be appropriate for some companies, but for many companies, it may be that a lower, or in very rare circumstances, potentially a slightly higher discount may be appropriate. And it's worthwhile considering what you think the value might be early on in the process. And HMRC do offer the facility of allowing you to agree your EMI valuation with them.
Which we'd very strongly recommend.
Yes, please go and get valuation agreed with HMRC.
Yeah, it will give you a lot less trouble later in the day when you're actually trying to sell the shares on an exit, and you've got people trying to figure out what, if any, tax is due.
Thank you both. So we've had another question. So the question is, if the company is a startup with no current value, are the limits the same in terms of percentage?
So the limits, if I think we're talking about the 250,000 limit, yes. But we still very strongly recommend that you write to HMRC and agree, even if it's a nominal value for the shares under option, that you still do that. And just as a minor point, when shares are issued under EMI option, there must be you must have arrangements to make sure they're fully paid when they're exercised. So if you've got penny options, the lowest price you could ever agree would be, in effect, so options over penny shares, in effect, the lowest price you could agree would be 1 pence for exercise. Yeah, exactly.
Yeah. So I think sort of fundamental bit from that is the ability to apply minority discounts, which can be significant, and clearly that lowers the threshold for employees to be able to buy those shares at a low cost and then exercise it at a pro rata value later down the line. Okay, so what about on an exit? What happens then? How does the scheme unfold at that point?
Yeah, so hopefully happy days. You've got a lovely offer for the company, and your employees, maybe between them, have 10% under option or something like that. So at that point, you obviously want to advise the employees that they have the opportunity to exercise their options. and let's imagine maybe someone senior in the company has that 5% option that Thomas mentioned. What's that going to look like for that individual? So potentially, if we're selling at say 20 million, lovely result. Holding 5% under option was potentially £1 million of proceeds. That individual still has to pay for the option exercise, so that's 125,000 based on Thomas's example. The balance then, and that's usually funded, by the way, on the way in which the proceeds flow works on the actual transaction, which is more Matt's area than mine, but we will do a
So
sort
the
of
employee
fund.
doesn't need to find 125k. Yeah.
Not immediately, but he will need to produce it out of his proceeds, in effect. So the employee then, assuming that the options were granted at market value, will need to find his 125,000, and he'll be making a gain of, if I got my maths right, 875,000. Assuming that everything has met all the various tests and so on, that should then be under capital gains tax. I mentioned before, we're probably talking about a rate in the region of 18% based on anticipated tax rates that are coming in next year. So that would be, according to my maths, which I carefully scribbled down, just over £155,000 of CGT to pay, and then with the remainder of the proceeds obviously being what they take home. The other thing to mention there, which Matt always reminds me of when we're doing a transaction, is there's a lovely corporation tax deduction at that point as well. So just imagine our 5% shareholder who is making a gain of 875,000. There'll be a corporate tax deduction on his gain. Assuming that the CT rate is 25%, there's around effectively a £220,000 benefit for the company as well in terms of saving corporate tax as well.
I think just sort of adding to the implications on that on a transaction. So when we see these crop up in deals, the corporation tax liability of a business is typically deducted from the headline price to get to what the shares are worth. So that accrues in the accounts to completion. Now, if we've got this big tax deduction that we can realise from exercising an EMI option, quite often that liability turns into an asset. So the company at some point will have a cash inflow or a cash benefit. And often sort of the negotiation is around ensuring the buyer recognises that that is going to be part of it and therefore added to the price. So actually all shareholders are benefiting from the share option to the tax deduction value. And then the negotiation is around actually when they should be paid it, because the cash flow isn't necessarily instant. It may be when the sort of corporation tax returns are sort of filed in the next year. So that's quite a key point, particularly on exit. The other point to probably just mention is around how buyers view these schemes. So there are scenarios where a buyer may decide to acquire a business and the management team have an EMI option in place, and they may want the management team to continue in post after the transaction. If the management team are walking away with millions and millions and perhaps don't have the drive and incentive, there is a risk sometimes. So it's about getting that balance right. But ultimately, the incentivization of the management team post transaction is going to be something for the buyer. But it's something to consider if you're a shareholder and you're trying to incentivize management. If it goes too far, there is a risk sometimes around that sort of ongoing engagement post deal. Right, so we've had another question. So am I right that the owner who is selling has then lost 875k?
Well, so yeah, no, it's a reasonable question. So if you are of the view that your business will not grow in value by the contribution that your employees are effectively making into the business, then you may well say, well, this is pointless. I'll just give them a bonus. I'll know what I can, effectively, what effective amounts might be. That bonus, by the way, probably won't be tax deductible. And that'll be an effective route to incentivizing them. But I think the other argument is that the working together as part of a team is more effective to grow the value of the business. And certainly that's what private equity on the whole have bought into, because you'll notice they always give quite large tranches of sweet equity to management, and it's not really because they're the most generous group of people, it's because they think it is effective, that you will grow the value of the business further by more substantial contribution and effect from those senior managers than by giving them a sort of flat rate salary or a bonus. And I guess the other argument is you can then afford potentially to recruit people who will be more valuable to the business because you can offer them this extra something that you might not be able to do through the means of your available cash on a sort of day-to-day basis on salary.
So yes, giving up value, but ultimately, by doing this, does it actually create more value and pay for itself in other ways?
Is the pie bigger? Is the question.
That's the question. Yeah. Okay. Fine. So when we're designing these schemes in terms of trying to sort of drive particular behaviours, what are the typical performance criteria that you might want to consider?
So just to say, there's no requirement to have performance criteria, but a lot of people do like to have performance criteria. The classic, easy performance criteria might be financial ones. So if the business hits whatever of EBITDA, 500,000, 5 million, whatever the right number is, we're very conscious that on deals that EBITDA is what usually drives multiple. She says, looking at Matt, but I believe that is very much the case. So by effectively driving people's performance towards certain financial objectives, you should then grow the value of the business, and everyone hopefully should be happy at the end. You can have more personalized performance targets, by the way, and sometimes we do a slightly more complex type of arrangement whereby the more the business effectively generates in process and you get in proceeds, the more options you get to exercise. And so that's quite a neat way sometimes to effectively, again, the more it's worth, the more you'll get because you've effectively driven that value is the purpose of that. So yeah.
And I guess just to say that some of them are just exit only, so you may not have sort of that EBITDA. It may just be on an exit. It happens.
Yes, but I mean, EBITDA could be measured at the exit. You could look at the last 3 years and have you delivered X, Y, Z of EBITDA? Yes or no? So yeah.
Okay, so say we put a scheme in place and there are certain criteria. Say it's EBITDA criteria. What happens if those criteria aren't met?
So usually, if the performance criteria aren't met, then the options may not be exercisable. But there is, the facility to build in flexibility to these kind of conditions. So the plans that we put in that use performance conditions, there's the facility to relax these performance conditions at the direction of the board, so that options can be exercised. This is, this can be very useful, say, in the example of financial targets where they've been very narrowly missed, but you still think that that employee has done a really good job and deserves to be able to exercise their options.
Yeah. We saw that in COVID, didn't we, when there were some misses when you wouldn't have expected it, maybe.
Outside of their control.
Yeah, completely, where it's outside their control, but you still want to recognize their contribution. And having this kind of flexibility is something that we strongly recommend, precisely because of those events outside of your control, where you don't want to be left in the unfortunate scenario where something has happened that no one could really have foreseen, but because of that, you're now unable to exercise your options. So that kind of flexibility and the ability of the board to decide to allow people to exercise their options can be a kind of backup for these performance conditions.
Thanks, Thomas. And then I guess a sort of add-on question to that is, what if an employee leaves partway through? If there's a scheme that's going to last a few years, what if they leave midway? What happens to the options at that point?
So usually if employees leave, their options will lapse. That's the most common thing we see. Occasionally we have slightly more complex arrangements that people want to put into place, and you can facilitate people keeping options in certain circumstances. Maybe if someone gets seriously ill or something, but as I said, the general approach and what you might call the most common assumption is that options will lapse when someone leaves.
Okay, and what about sort of voting rights, sort of during that period, whilst the options are in place, but they haven't yet been exercised?
Yeah. So first principle: when you hold options, you don't hold shares. Therefore, you cannot have voting rights because you don't actually hold any shares. And then I guess the second thing to consider is it's okay, so I'm letting you exercise your options, and maybe there's an arrangement whereby you're exercising your options after 2 or 3 years, and that's what has been put in place in the option agreement. When you granted those options, there will have been over a specific class of shares, and you can choose when you're granting the options whether you want employees to have voting or non-voting shares. So for our example, where we had the guys coming up for an MBO, that group might be quite suitable to have voting shares so they can effectively participate going forward. Whereas probably as a general rule, you don't necessarily want lots of small shareholders participating with votes. So maybe for what you might call your general pool of employees, you'd prefer them to have non-voting shares.
Thanks, Kate. And I guess sort of another added question to that is dividends. What about rights to dividends?
Yeah, that's fine. And I should have just mentioned, by the way, on the votes, obviously, if you get to an exit and you're exercising on an exit, the votes at that point are probably fairly immaterial because you won't get the chance to be voting. On dividends, yeah, very similar. You can decide what class of share you're granting options over. So there's no right to dividends on unexercised options. Once you hold shares, they can be over either dividend-bearing shares or non-dividend-bearing shares. That's the decision you make when you're granting the options.
Thanks, Kate. So then just looking at the sort of how long EMI option can be in place for, are there any sort of limits and restrictions on the duration?
Yes, for EMI, there is a limit of 10 years from the date of grant for the scheme. That doesn't mean that the options will necessarily lapse at that point, but they will stop being treated as EMI. You can build in the functionality that those options that then at that point turn into unapproved options. Most of our clients would say probably use exit options. So if the company is being sold, then they can be exercised, and the time limit of 10 years is unlikely to be relevant. But it depends on every company's circumstances and what you're trying to achieve with these options. If you're trying to get employees to participate in share ownership without necessarily expecting a sale, then you're more likely to instead want them to exercise after a certain period of time has passed. And this can be set up in the documents, and you may wish to use things like vesting at that point that says, you can exercise half your shares after you've been here for, I don't know, 2 years, and then the rest you can exercise after you've been here for 4 years. But it really all depends on what you're trying to accomplish. And you can be flexible as well. If you think that an exit is possible, then you may wish to build into your option agreement something that says, you can exercise after this period of time, or if we're coming up to an exit, then we'll allow you to exercise at that point.
Thanks, Thomas. So we've had a related question, which is a very good question. So what it is, it's saying in a circumstance where options have been exercised, so not on an exit, so the employee holds those shares and then subsequently leaves, is there a way in which there can be an agreed buyback price on their exit? Or perhaps the broader question is, what other mechanisms can you put in place to retain those shares within, I guess, the company?
So that would be more, I think, a question for the articles of association of the company at that point. The EMI options have been exercised, but often what we see is clauses in the company's articles which sort of define different kinds of shareholders and the circumstances in which shares need to be bought back. So you may have, say, a category of employee shareholders, and depending on the circumstances that they leave. So for some people, it may be that they leave because they become unwell or something like that, and they're no longer able to work in the business, and you may wish to allow them to keep their shares. But if they are what's called a bad leaver, which sounds worse than it is, but it can just be that they've resigned and joined someone else, then there may be a clause in there that says, in that case, we'll buy back your shares at this agreed upon price, and that would be defined in the articles. So it may be the value of the shares at that point, or it might be something much lower. It might be their nominal value or similar.
I guess it comes down to defining what is a good lever and what is a bad lever.
Yeah.
Yeah. Okay. So scenario where companies decided to implement an EMI scheme, how do they decide who should participate? Where do they draw the line across their employee base?
Yeah, it's completely up to companies and what they're trying to accomplish, really. They decide who participates, and it is flexible. You don't need to include, say, everyone of a certain grade. I would say typically EMI is more often suited for senior management in larger amounts, but you may still wish to, possibly give other employees, say, a smaller portion of their options under EMI. But it's important, that you're sure of who you want to grant options to, because once you've granted options, you're quite limited in what you can do at that point. There's not really a facility that's easy to use to take options away, unless they have happened to breach the conditions of the option, and most commonly that would be something like leaving the company, at which point the options would typically lapse anyway. So it's important to think carefully about who you want to grant options to, because it's hard to change your mind after.
Absolutely. I suppose it's really about influence, isn't it? Who are the members of the team that are going to influence whatever those objectives in the longer term happen to be? Because ultimately that's the idea of incentivizing them to achieve those objectives. Okay. So how about the valuation? How is that undertaken? How much should the employees pay?
Okay, so valuation usually we carry out very early in the process. It can help then, in effect, assess some of the other questions and decisions you might want to make. The valuation for tax purposes, there's various case law and so on around it, and it's usually based in effect on your historic results. Circumstances do vary though, so that you'd need to use an appropriate valuation basis. Always we recommend that then it goes to HMRC for approval. Absolutely so valuable, so useful to get that approval. Okay, so you've now got valuation approved by HMRC. They've come back to you. They'll say probably, by the way, you've got 90 days now to grant your options. Let's just say that valuation is for £1 a share and your nominal value is £0.01 a share. So good news, we're north of our nominal value. So don't need to worry so much about whether we're meeting that. That valuation then, that £1 per share, is effectively the post-minority discount valuation. We might then go to the employees and then offer them options over however many shares at £1 per share. That's then using effectively a tax market value option price. At the point we then get to exit, that usually using that tax market value exit price is simpler because we then do consistently fit within the capital gains tax rules on exit. There's slightly different rules, which I think we might talk about in a minute if you grant at a lower value.
Thanks, Kate. So yeah, do you want to carry on in terms of what that means if a valuation's been done, they've calculated the minority discount, they've come up with a sort of an exercise price, but actually it's still felt that it's too much for the employees to pay.
Yeah, the classic example might be I promised, so and so these shares a couple of years ago when the company was worth a lot less, and I haven't got around to doing it yet. So we really don't want to sort of give him that higher exercise price, which is fine. So the good news with the EMI is you can grant options at any price between nil is actually acceptable in certain circumstances, but you should talk with your advisors about that, to the tax market value that you've agreed with HMRC, or indeed a higher value. If you're agreeing a value that is at or higher than tax market value, then, as I mentioned, there'll be no extra tax due on exercise. If this guy who you promised the shares to a couple of years ago, you're actually going to offer him effectively penny options when you've agreed a valuation at £1, then when you get to the exercise, that 99p difference will be taxed, either as income tax or PAYE at exercise. And then it's only the element above that then that will be part of your capital gain.
Fine. So a bit of sort of high tax and a bit of low tax, depending on the
Help people in effect. Yeah, exactly.
Fine. Okay. And this is all about incentivizing people, and so communication with the teams. How should these things be communicated, and how should they be discussed with the relevant people?
I think it's critical, really, is that you're bringing your employees along with the journey of the business as a whole. You as a business owner want to share your vision of how you expect things will look, in 5, 10 years, or on an exit. And what does that mean for the employees and the options that you're proposing to grant for them? So it may be helpful to sort of set out illustrations of, here's what your options are worth now, here's what they could be worth in 5 years if we achieve an exit along the lines that we're going for. And employees may find it very helpful to see things like financial or business plans that you can share with them to show how you plan to achieve this growth. And that is part of an exercise that we often help our clients with. So we go over and explain to employees, this is the potential tax benefit of these options. With a scenario maybe that the employer has provided, and we find that very often works quite well.
I think it'd be a good idea always for the employer as well to do something like an annual update almost on the options to show hopefully that you're growing and meeting your financial plans and it's all going along well, and so you can have an idea of how things are progressing.
Thanks, Kate. Thanks, Thomas. So I think we're sort of coming towards the end. I think there'll be sort of a few more final remarks. So if there are any burning questions that you want to throw in now, please do. So just giving people a bit of time to do that. Kate, do you want to just summarize any key conclusions and final remarks that you have on this?
Of course. So I guess one thing I would say is we spend a bit of time doing transactions often, which does not make Matt all that happy, trying to sort out any issues on EMI options. So we'd strongly recommend that you get it all done appropriately and well. Get your valuation agreed. Make sure the documents are good. Make sure effectively that we've got a smooth process, because that will reduce a lot of stress and worry potentially on a transaction that can occasionally happen when things haven't been quite drafted correctly, and no one wants that sort of aggravation or things being tied up in escrow or anything like that. So big emphasis on getting it right.
I mean, it can break the deal. We have seen circumstances where it's not done right and it unravels the deal. So absolutely critical.
Yeah. Please get it right. So good, well drafted documents, valuations on time. I think also the thing I would say, don't leave it too late. We talked to a lot of people who were coming up towards a transaction, or we're going to do a transaction next 6 months to a year, and we've been meaning to do EMI options for the last 3 years. And please, could we have done it 3 years ago? And I can't wind back the clock, but if we are able to meet the requirements still of the EMI legislation, and there is a point, by the way, when you will not be able to do that on a deal, then obviously we will support you in granting options, but almost certainly your valuation is clearly going to be a lot higher when you're coming up towards a transaction than it would have been when you're actually starting up. So please don't leave it too late. And yes, I think documents right, valuation right, do it sooner rather than later, and have a plan. Have a view about what the end looks like, think it through, and then we can work with you, or your advisor can work with you to get something appropriate in place to work towards an end goal.
Brilliant. Thanks, Kate. Well, we haven't had any more questions, so I think we'll.
I think we have. Sorry, Matt. I think they might need to scroll down.
Sorry, we have. Oh, we've had a couple. Apologies. Okay. So what are the options to reverse out the scheme in the instance that you're a year or two in and then you run into an issue with the employee which results in a termination of employment either through redundancy, dismissal, or settlement agreement?
So the default position really with most EMI options that's drafted is that when you leave employment, the options lapse, and that's certainly the case for the agreements that we put together. So in your example, the normal course way it would work is that, at the point where they leave, their options lapse. They no longer have entitlement to exercise anything in the future. We do include the flexibility within the options that maybe the board wants to potentially allow people to keep their options or to exercise their options when they leave. But provided the options are well drafted, when people leave employment and you don't do anything contrary to, say allowing them to keep their options, then they'll lapse in most cases.
Thanks, Thomas. And I believe this is the final question, unless another one snuck in at the bottom. So we mentioned about costs to set it up. What about sort of ongoing other annual costs involved?
So the first thing I would say is there is an annual return you have to make. Please remember to do it. It is it's another thing that will be looked at on an eventual transaction. It's not a complex return usually, though. It's quite a short form report. Often, as Thomas will remind me, it's a nil return. We're in the middle of return season at the moment, by the way. They all need to be filed by next Sunday, I think it is, Sunday week. So there's maybe a modest cost for doing your annual return, but to be honest, many people do them themselves, particularly nil returns. That they're not very complex, and you do it online with HMRC. There are no other costs per se, other than your choice whether you wish to do so to keep the employees up to date on your financial progress, that sort of thing. There's no other admin costs. It is usually a case of people then trying to find the documents once you get to a transaction and pull out what they did several years later. So it's not heavy admin sort of arrangement like some of the more listed company type arrangements are.
Brilliant. Thanks, Kate. No more questions. So I think we will wrap up this time. So just final sort of remarks from me. I hope you've all found this an interesting webinar. A recording will be sent around afterwards if there's bits that you want to look at or share with colleagues. Please do reach out to us if you're considering putting in an EMI option. Kate and Thomas, I'm sure, will be really happy to discuss what you might be considering. So finally, thank you, Kate and Thomas, for sharing your expertise, and thank you all for joining.
Thanks, Matt.
Thank you.